until the red light in the top left corner. Oh, you might not see it, Justin, but all right, we're live. All right, guys. Kevin and I would love to welcome Justin Huhn. Remember, I pronounced it right.
Perfect.
I'm sorry, I don't want to make a big thing out of it. The Uranium Insider, man. So everybody knows Justin. Anything uranium related, there he's the guy. And today, incredible green day in uranium. So the timing is good for recording this today, Justin. Kevin prepared some charts of the uranium sector, and we're super curious to see how you see any fundamentals or anything you see in those charts that why, I don't know, the price action would move, give insight, and yeah, so anything that comes to mind. But before that, I'd like to let you introduce yourself maybe more properly and tell us so everybody knows right away where they could find the Uranium Insider newsletter and Twitter, etc.
Sure. Yeah. Thanks so much for having me, guys. Appreciate it. Yes, my name's Justin Huhn. I'm the founder and the publisher of the Uranium Insider Pro newsletter. And we've been doing that for 2 years. I have a small team of dedicated uranium analysts, including some very experienced hedge fund guys. We spend 100% of our time on the uranium market. So we just live, eat, and breathe this stuff. I'm pretty frequently on Twitter at Uranium Insider. Our website is uraniuminsider.com. And yeah, we focus 100% on this sector. It's a very, very complicated sector. It takes a lot of time and energy to really dig into the uranium, the nuclear fuel cycle, and apply the fundamentals of the sector, which are very profoundly strong currently, to the investing market and create actionable information, between both the technicals and the charts, the fundamentals for the sector, and then the investable stocks, which there's only about 65 of them currently. So we put out a monthly newsletter that's very in-depth. We put out inter-month bulletins, emails that go out with actionable trade alerts and prescient information on the companies in the sector. And we have a focus list of 10 companies that we have chosen to invest in and recommend that we feel are the best risk-reward positions within the sector. And yeah, so I'm pretty accessible through Twitter, through our website, uraniuminsider@gmail.com. If anybody has any questions, I do my best to communicate in a timely manner, depending on the flow of emails, which, the sector's been selling off the past few weeks, so it's been a little bit quiet. But it seems like maybe we found a bottom. But I look forward. You guys are both technical masters. I've been following both of you for a very long time, so I'm looking forward to this conversation. Yeah.
It's
okay.
always
Well,
the
should
hardest.
I just?
Sorry.
Sorry, Patrick. Go on. I don't want to talk over you. Sorry.
It's always the hardest part. Like, it's quiet, but contrarian people should, when it's quiet, that's when the price goes down. That's when they should flock towards you, because those are the best times to enter. When it starts getting quiet, that means the price is not overbid, and if you're in a bull market, then you have, hopefully people would going to start following uranium once again and not wait until it does new all-time highs, when it's stretched away from moving averages. But I think, yeah, we're going to see in the charts today there that the corner, it looks to have turned, and let's see where those upwards targets are.
Sure. Yeah, I think you make some good points there. It's the sentiment is always such a strong indicator, especially in these resource markets, and it's just, some things never change. When things are euphoric is really the time that you should be getting a little bit fearful, and when things are just despondent is when you should be getting greedy. And I don't know that we're quite at a despondent level. The sell-off that's been happening in the equities, I'm sure we'll go over that, in the last, let's say, 6 to 8 weeks, has been, in my opinion, a perfectly healthy pullback, but it did go a bit deeper and a bit faster than any of us really expected. The volumes are pretty low, but we'll go over that. But yes, you're right. It's really, I tweeted out yesterday, the day before, that, as an investor, one of the wisest things you can do is act the opposite of your emotional reaction to what's happening in the markets.
It's the toughest thing.
It's very hard.
The toughest thing.
Yeah, that's not easy. It's easier said than done, isn't it? We've got the spot uranium price here on the on the screen in front of us, and it's just showing from a technical point of view how the spot uranium price actually broke out back in July of 2018 hit the top of a rising channel that was still just in its early stages of forming at that time, and then came back down and reconfirmed the support on the rising channel, and at the same time reconfirmed or actually confirmed for the first time the existence of this arc, which I'd been drawing. It's since come back and has retested it on at least 4 times on a monthly basis over recent months, and has now finally started to pull away and start to move a little bit more convincingly to the upside. You can see my sort of projection there up around the upper resistance rail, up around 39 or just above $39. I suppose it depends when we get there. It could be closer to $40 by the time we get there, I suppose. But that kind of level is pretty key. It's horizontal resistance in here as well from previous price action. So that zone around there is going to be quite key. We may come back down and test the edge of the arc, or we may just blast through it, I suppose. So interested to hear what you think on that, Justin.
You know, it's funny because this is really kind of one of my favorite types of technical setups here, but at the same time, this is such a weird market with this commodity in particular. It's very difficult to justify charting the price of this commodity when there's so many moving parts that are affecting when people are buying, when people are selling, and at what price. But with that said, I'm loving just the higher highs, higher lows. It's a gorgeous looking chart in my opinion, especially for a contrarian, because now we've had a few years of kind of confirmation of this new uptrend rather than just trying to buy the absolute bottom. And even if you did buy the absolute bottom in the commodity, you know, the stocks didn't really react in a long-term fashion over the years that this has been chugging upwards. You know, we still had the bottom in many equities was, you know, March of last year. So it's a great setup. And interestingly enough, you know, at most of these points where the price got rejected or where the price found support, there's some type of fundamental setup, or at least some seasonality that happens a lot with this commodity. But I really like this chart.
Kevin, before you move on, can you zoom in on that arc where it just bounced? I just want to, and there's also the stock RSI that's turning up, but I just want to see the details of how many times it really. So we had a strong pullback a few months back, this for a spot, and then after that, retrace, hit the arc, then went up, and now for 2 months in a row, it's or 3 months in a row, it's still. What's the seasonality, Justin, for uranium? Is it like it does lows at a certain period during the year, every year?
Yeah, honestly, usually the lows, and this was different last year and so far this year. But previous years, let's say the previous 2-3 years, the seasonality was a little bit different. So typically what happens is you have a really quiet period in the summer. You know, all the fuel buyers are on vacation. They've done their buying for the year. The markets are generally quiet. And then in the autumn, traditionally you've had a number of uranium related conferences. You had the WNA conference, which actually is going to be happening this year in September. And then you have a nuclear fuel conference that there's actually one of those happening right now as well, but typically that happens in October. You also have the fiscal year for the US utilities that starts October 1. So you have a bunch of events coalescing during the late Q3, early Q4, when usually there's all of the new information that's coming to the fuel buyers that have been on vacation for a few months. Then they start to make their decisions. So oftentimes the commodity will rally from, let's say, November, December through March, and then it'll kind of chop backwards and chop along sideways. I mean, and this is, over many, many years. If you look at, like the equity clock, the seasonality charts going back 10, 15, 20 years, you have pretty consistent rallies and sell-offs in the commodity, in the equities. But what happened last year was obviously the COVID shutdowns, and those two big bars you see that were like probably April, May of 2020, those two big green bars, that was when Cameco was buying. They were buying pretty heavily, and they were demanding fast delivery. Is that March, April? Okay, March, April, yeah. So that price rise right there actually was almost entirely in a single delivery location because Cameco was the buyer. So in many ways, it wasn't really a legitimate move in the spot price. But now what we're seeing is the price starting to tick back up again without having that premium for that one delivery location. There's a very slight premium, but we were talking like a 10+% premium during that rally.
It's insane that during the March Madness there, like it didn't crash, barely moved the uranium. It was already on the rail, and it just waited for the March Madness crash to finish, and then it just rocketed up. Look at that! It barely everything got hit visibly except uranium there during the.
Mm-hmm. Yeah, that was a reaction. I mean, there was some trader action during the same time, but it mostly was Cameco buying because they closed Cigar Lake, and then Kazatomprom announced they were going to stop their well field development. So the market was reacting to those closures, and the commodity reacted to that new volume that came into buying the commodity.
So let's say there wasn't Cameco buying there. What would have happened to the chart? It would have just grinded sideways for a few more months until October came.
I think we likely would have seen, well, if we would have speculated on, it's hard to speculate on the mines not closing when they did. So lacking that, we probably would have kept chopping along or maybe slightly risen. Now, if with the mines closing but Cameco not buying, I think we still would have seen a price rise. It probably just wouldn't have been so sharp and short-lived.
Interesting how the price rise, when it did come along, was very neatly controlled by the top resistance rail on this this rising channel. So it put a sort of a hard stop to it. Whether you look at this fundamentally or technically, it just kind of did stop there at that particular resistance line, and then drifted back down in much the same way as it has done over previous pullbacks to test the support levels. I just find it intriguing how fundamentals and technicals kind of come together in that way. This was all Cigar Lake driven, and then it was sort of halted, if you like, by a line on a chart. Odd.
Indeed.
Yeah. I do find that whole process fascinating. And I mean you look at how government policies around the world are progressing at the moment in relation to green energy and reducing harmful greenhouse gas emissions, and it's pretty clear that nuclear energy has a really big role to play in a huge part of the global energy plan going forward. So it's not, you can't just open a uranium mine overnight and suddenly start pumping out uranium from thin air. So there's like with most mines, I suppose, there's a lag between the demand and being able to match that demand. So there's a lot of fundamental reasons. I mean, you're the expert, of course, Justin. But there are a lot of fundamental reasons why there's an upward pressure here. Would you agree with that?
Yeah, for sure. Yeah, the language is almost universally positive around support for nuclear, with a couple of exceptions. Especially in the United States, which is still at this point the largest consumer of uranium, with 94 reactors currently running. About 48 million pounds a year the United States consumes of uranium for their nuclear fleet, and it's 20% of the grid here. To now hear, the Democrats and the environmental left of the political spectrum expressly supporting nuclear, which is, it makes sense, really, because the left is usually the ones that are screaming the loudest about climate change alarmism. And if you really sincerely are that fearful and concerned about carbon, then nuclear is such a clear and obvious answer. So it's nice to see that rhetoric kind of turn the corner. Germany is still forging ahead with closing their last reactors, even though Angela Merkel is expressing that they intend to accelerate their plans to combat climate change, yet they're going to keep shutting down their reactors. I mean, that's already baked into anybody who's done supply demand analysis and out into the future. We've baked in that Germany will shut them all down. So we're not expecting that to change, unless, of course, she gets voted out and or they come to the realization that maybe it's better to keep these clean energy plants running rather than raising old growth forests to burn biomass and to mine for coal. Yeah, there's a lot. I mean, globally, the support is growing. I mean, there's 54 reactors on construction right now globally. It's very much a growth industry.
Yeah, and I think, am I right in saying that many of these are sort of a new generation of more compact reactor that is more sort of I don't know quite how to put it, but more sort of appealing to the current crop of politicians around the world and the current sort of push towards clean energy. These new sort of smaller, more compact nuclear reactors, that they sort of seem to be more favoured in comparison to a lot of the old technology.
I think the technology for the SMRs, the small modular reactors, is much more palatable for a lot of reasons. They're much faster to build. They are modular. They are actually potentially built, built in a factory and then assembled on site. They're way cheaper and they're safer. They run on actually more highly enriched uranium nuclear fuel, but they're essentially meltdown proof in their design. None of those are actually being constructed yet, but the designs have been approved to some extent, and they're looking for, here in the United States, in the state of Wyoming, they've already set the stage to build one and assemble one at a former coal power plant to actually just tie into the existing grid where that coal plant used to be producing. And this is set, gosh, I'm going to butcher the dates, but it's really, really soon. It's something like they're looking for construction permits next year in 2022 and shooting to be able to actually connect it to the grid and start first energy production with this SMR in 2024 or 2025, I believe, which is a very, very fast time frame for a new nuclear technology. So all the existing plants that are under construction now are more traditional. I mean, there's a number of different designs, all with increased safety elements than what's currently running for the most part, but they aren't any of the small modular reactors yet. That's more of a, 2025, nobody was expecting one of those to be up and running by then, and we'll see how that pans out. But most people are expecting that more of like an end of the decade, 2030s, for these to really start to be more mass produced and come online.
Great stuff. I know here in the UK that it's very much part of the energy mix. We've got nuclear reactors not too far away from where I live, and we've got a number of them in the UK, and new ones under construction. I've just been looking at some of the uranium stocks today, Justin, and looking at a selection of them. I mean, we've got Sky Harbor here. They're up, what, 10% nearly, over 9%. Pretty constructive looking chart, having broken out and coming back down to test moving average in the breakout line there. We've got, I think, GovEx also having broken out. Huge green candle there, of course. Big breakout, and has been consolidating for a period of time with quite an ugly looking red candle there. But it's done is just tested to reconfirm the edge of the technical arc there, and the moving average again. We've got NextGen as well, doing a similar thing, having broken out back in November, December 2020 here, and moving up to where were we? Somewhere around $6 or a little bit above, and just coming back down to test those sort of levels from the previous highs, horizontal support levels. Energy fuels, often a favorite with people as well. It's kind of doing what I thought it would do, as represented by the red arrow there, having broken out, and is just retesting support. We've got I think Kanalaska uranium also. Actually, this is slightly different, this chart, giving a breakout very similar to the previous one back in I think it's 2015, 2016, where we saw this big move of I think it's something like 1,500% or something like that off the top of my head. And we're seeing a similar sort of move taking place at the moment with a similar sort of consolidation. Got this consolidation period back there in 2016. We're seeing a consolidation taking place just onto the moving average here at the moment, which looks primed for a move up. The distance from moving average as well, finding some solid footing here. We've got mega uranium as well. It's another arc formation. These arcs are present across many of the uranium miners. I'll move these labels out the way. You can see that we had the arc very briefly pierced on the back in 2008, but price soon got back inside it and closed inside it. Got another test of the arc in 2013 and one here in 2020. And at the moment we've been in a little bit of a bearish rising wedge, but we're just coming back to test the moving average here. So the arc suggests that price will rise a huge amount actually over coming years. And we've got next gen as well, which has had a breakout through resistance lines, a couple of resistance lines which you can draw on the chart here, and has risen enormously, and is just coming back and doing something which is very sensible really, and just cooling off a little bit and finding support at these horizontal support zone. So yeah, I mean it does look to me as though the uranium sector's it's clearly had a very, very good move, and just taking its time to consolidate and to digest those moves. How do you see it?
Well, yeah. I don't know, Kev, if you could put the URA, the uranium miner ETF. And by the way, I just got an update from Uranium Insider. Justin, following what he saw on the charts, he bought a big amount of all those charts you just put there, Kevin.
Well, we need some caveats with those charts and some disclaimers, but they are what they are, and they're all looking very bullish, aren't they?
Yeah. So, I think I remember looking at that one with you, Justin, there when we talked a little while back. I was wondering while Kevin's like doing his chart work, what's the relationship of the leverage of miners versus the uranium spot? Because everybody knows in gold, you hear it. If gold goes X price, the miners are evaluated to produce at that price. So, there's like a leverage. I forget, like there's a math, that's why everybody buys miners to have leverage exposure to the uranium spot. Does it, or the gold, but does it work the same way in the uranium sector?
Yeah, definitely. The miners provide far more leverage than buying the physical commodity. The physical commodity obviously is much safer through a vehicle such as Uranium Participation Corp, which is now the Sprott Physical Uranium Trust, or Yellow Cake. And then the ETFs obviously are quite diversified. So yeah, but the miners, you obviously take on individual miner risk with owning the miners, but they do definitely have much more torque to the upside and the downside.
Yeah, there you go. So there's the uranium ETF. There's a zone in here where we've got some horizontal, like kind of a turbulence zone. I dare say if we put the volume profile on there and take a look at the volume, there's probably going to be a node of high volume in there. Let me just fiddle around with the inputs on here just to get it a little bit more granular. There we go. So yeah, you got a little bit of volume node in here, another one down here, of course, and the main one way down here where all this trading took place as the basing was occurring. But notably, very little volume resistance once you get above this level here. Not a lot going on in terms of the volume here, so that very often means a fairly steady and sort of smooth ride back towards the top right-hand corner of the arc. But of course, we'll monitor that over the coming couple of years and see how that starts to pan out.
Yeah, the URA ETF is the longest standing ETF in the space. It's the most liquid. There's another one, URNM, which is it's going to be harder to chart that on a long term, but it's a pure play. URA is actually 70% allocated to uranium. There's some other mining stocks that are mixed in there primarily to provide liquidity, but so yeah, they've both URNM and URA have had some really good gains since last year. Their AUM has absolutely soared. And so URNM, for example, has gone from an IPO last January at $3 million to, I believe they're around 400 million AUM right now. Yeah.
What's AUM? What does that mean?
Assets under management.
Okay.
It's just the overall value of all of their holdings.
Okay.
Yeah.
So it has nothing to do with the
chart
market cap. The market cap is a multiple of that, maybe.
Yeah, I think, well, with an ETF, the AUM would technically be the market cap, I believe. Well, the market cap is going to be, the number of shares outstanding times what the share is trading at. But their assets under management is basically the valuation of their holdings at the percentage allocated.
Technical point of view, this area just that I've just highlighted here is going to be quite important. It does look as though the price is wanting to sort of come back and just test that 12-month moving average around about $16 or thereabouts, and the support area for the ARC is in the same zone. There's no guarantee, of course, that it's going to come back down to the $16 area, but it does look as though it probably wants to at the moment. It could just take off and continue up here and not test the edge of the ARC for a little while yet, but we've already had a test here and a test here, so it could just turn around and break through and come up here somewhere before it comes back down. But there's a reasonable chance, I think, probably more than a 50-50 chance that it'll come back down just a little bit further, maybe another 10% or so, possibly.
Yeah, this chart actually was holding up better than most of the individual miners up until that recent sell-off. It sold off pretty good today and yesterday, and possibly the day before. So most of the miners, if you were able to draw a similar arc on a number of them, they've probably gotten close to that point already. But URA still has, I think, another 10 or 15% to go if it wanted to retest the 200-day moving average, when a number of them have either bounced right off of it or broken down below it slightly.
Yeah, I think Cameco, one chart I didn't show was Cameco, actually, just talking about arcs. There you go.
In your newsletter, do you so when there's possible entries like getting close to the 200-day moving average, like they get an alert, look, guys, we're close to the 200-day. This is maybe an opportunity to add some shares.
Yeah, I update a weekly watch list every week before the Monday open, where I go over all of the charts of our focus list holdings and highlight just different things to look for in the charts. And we'll definitely say, look for these levels to enter or to add a tranche to your holdings. We haven't yet sold, other than trading in and out of positions, selling one company to buy another. We've done that a number of times over the past year. But as far as taking profits and trimming, we don't really trade in and out of these stocks as long as the fundamental setup is strong and we still have a long ways to go in the commodity price, primarily because this market likes to move, kind of catch you off guard, and it moves so fast when it does that to sell and create a tax event and hope to get back at a reasonable price lower to actually justify the profits from that sale after the taxes is tricky, to say the least, and difficult to time. So what we do is we highlight levels of overbought, oversold for our members, but we have yet to actually trim our positions. We've only been adding.
Yeah, and look at the velocity, Kevin, of that explosion. It's the same angle of ascent that they had in 2001 to 2006 there. Look at, any of those angles. So you're right, Justin. Understanding past behavior of these stocks, you know that if it's just starting to move up, why try to trade it? I understand, like, people that are in front of their screen, they see minus 5%, minus 8%. They see a few of those, and then they bail. But that was exactly the moment that if they would have zoomed out, they would have saw they were still above an inclining 200-day or like a long-term trend. They would have said, man, why?
Yeah.
Because folks, they see these long-term targets, but after that, they play them short-term. It makes no sense.
Yeah, so you got a 69-degree angle of ascent here, you got a 69-degree angle of ascent here, you got a 69-degree angle of ascent here. Things you look for to take a long position, you need to look for price bouncing off a support line, and where there's an arc, price bounces off the arc. Here we've got a little bit of a horizontal support line here with maybe a few touches here, a couple here, and a couple more here. So that was a confirmed bounce there. It went through the 12-month moving average, and then it broke through the declining trend line. Those three things, bouncing off a support line, through the 12-month moving average, and through the declining trend line, that's the signal that something big is about to happen here. Yes, it can do what I've indicated is quite likely, is to form a bullish pattern here, which will give you a bull flag. So my sort of feeling was that after because you tend to get either a bull flag just below the breakout level, or if it just bursts through and breaks out, you'll get a bull flag just above the breakout level, because either way, price is needing to take a breather. It either needs to take a breather to give it the energy to break out, or if it's already got the energy to break out, it takes a breather having done so. And what's happening now is it's taking a breather having done so. So what I'd be looking for is some kind of bullish chart pattern to form here, that will then catapult price upwards. And as I said before, to keep an eye on these sort of volume nodes, these areas of significant trading volume, because once you see price moving above these trading volume zones, there's less and less resistance for price moving upwards. So yeah, that's, I mean, from a technical charting point of view, this is really, really nice stuff, and it's all behaving exactly as you would want it to in a very young bull market.
Yeah, Chemical used to, it looks like the best chart and all of that, but I'm just saying the best chart. I know nothing about those fundamentals, but because we have a long-term data, it pleases me. Like the more, because on a short-term chart, and if the uranium company didn't exist in the 1997 or 2000, you don't get to see how they previously performed in a bull market,
Right.
But
yeah, there's a few companies that you could probably chart long term, which would be Denison, Laramide Resources, UEX.
Denison was
do a DML. It'll go back.
the
It'll go back longer.
the Canadian version, Kevin. Always Canadian.
I should know. Well, look, I have done it. I've done them all. So it's all, there you go.
Yeah.
It's all done for you.
Nice.
Wow,
Nice.
look, you see,
At some
so
stage
that
or other.
move, that's pay dirt. That's the holy grail. That move from 2003 to 6. That's what you want to grab. That's the money. Like Edward Gofsky says, Kevin, it struck me. It's you want to extract money from the markets, right? You don't want, and yeah, that's the opportunity right there.
Yeah, I mean, this breakout here is what I said before. You're looking for a bounce off the arc. Well, we've got that. You're looking for a move through a long-term resistance line. Well, we've got that. And you're looking for a move above the long-term moving average. So really, at this point here, you've ticked all three of those boxes. You've got the bounce off the support level through the moving average, and you're above the declining trend line. So that point there at around about 55, 56 cents, that's where all those criteria are met. And if you're wanting to take a position and take advantage of all of this, then from a technical point of view, that's where you should be doing it. And we're just coming back now to have a little bit of a breather. So if you missed it the first time round, sometimes if you're lucky, you get a second bite of the cherry.
Can you zoom in, Kev? Because I think it came very close to that 1 year moving average. See that wick on the smaller time frames? That pullback could essentially be complete already, or it's getting close.
I mean, it could be complete. I mean, as long as you've got the arc down here, then that is the sort of ultimate target area for any severe pullback. And sometimes you get a little wick coming down outside the arc, as we had here, which was caught. The price was caught by this sort of trend line or resistance line that goes back. I mean, you can see that when you draw these lines, it's very hard to draw them so they catch every candle perfectly. It's a kind of line of best fit, and it's why I often try and describe these as not solid lines. What you're actually drawing here is a sort of it's like a force field or a magnetic zone. The price, when it hits it, it's not a brick wall. The price isn't, doesn't have to stop exactly on that line. Sometimes it just breaks it a little bit, but acting as a sort of a repelling force, it pushes price back underneath, and then when there's enough energy, it bursts through, and you can see the candle there. It tried and failed, and then the next candle straight up and through the line. So that line there, if you continue it on, it brought the price decline to a halt, and then it very quickly reversed and went back inside the arc again. So that's how these sort of trading patterns form, and that's why these resistance lines and support lines are so important, because they carry on into the future. You might have thought it had done its job here. It's supported the price, and the price is gone up through the resistance line and hey, we're off and we're away. But no, we weren't. The price came all the way back down, and all that time later, in fact 3 years later, it came down, and suddenly that line is important again. It's still got a relevance even then. So very often, it's quite important to sort of follow these trend lines on into the future, because who knows, if this was to break down here, it could come down and you could get a spike on the candle that's caught by that support line there. Mm-hmm. But the ARC, doing what it does would pull the price back inside.
Well, if you don't look at long-term charts, you'll never see those lines. You don't even know they exist. I call them invisible resistance or invisible support defined on higher time frames. So those day traders, the price action goes down. They think it's going down to rock bottom. But if they would have zoomed out, they would have seen, no, don't worry. This is historical support. It's going to bounce. It's crazy. I was wondering, Justin, there, maybe when the uranium bull cycle is going to be over, are you going to close shop with the Uranium Insider, or
That's a good question. I have no idea. I mean, we're just going to have to take it as it comes.
Because we don't know, do you have some guidelines when okay, the uranium is below, let's say, a 5-year moving average? Look, guys, we've had a fun 10 years. It's we might hibernate for a few years. Because I'm trying to cope with that with the gold and silver, because it's going to be the same thing, right? We know the bull is not going to run forever. And
yeah, I think that it's really going to just be a blending of a number of different signals, fundamentally and technically, that we're going to have to look for. So it would depend on the reason for the bull market ending. I mean, if the reason for the bull market ending is something like a Fukushima, which primarily killed the market due to Japan closing all of its reactors. Because what that did is that actually shifted the supply-demand balance significantly, and the implications for that downturn were very long-term. And some of the more honest CEOs in the space just actually, one of them in particular, communicated with his shareholders at the time and said, hey guys, this is going to be some rough sledding for the next 5 years at least. So something like that would obviously trigger a get out and stay out for a while kind of thing. So I don't know what that would mean for our service at that time, but if we're looking at a spike in the price of the commodity with the underlying health of the nuclear market intact, I'm sure that we will still have a relevant voice in the space for investors to be trading around such an event. And that's honestly probably the more likely outcome will be a drastically rising price in the commodity, euphoric, crazy moves in the equities, followed by a pullback. I mean, this is what happened last time. You had the spot price run to $134. Then it pulled back down. I believe it was into the $50 to $60 range, which really is kind of the cost of production globally on average. And it started to stabilize and come back up. And that's when Fukushima happened. So it overshot, it came back down to a reasonable level, and it was starting to work its way toward quote unquote balanced market, because that overshoot triggered projects to come online, or at least to be progressed towards production. Well, those projects, they didn't just stop. They kept going towards production. Some of them eventually actually produced, even as, Fukushima happened and reactors came offline, there was still production that was ramping into the market. So we're just going to have to take it how it comes. We don't have a crystal ball, but, to put it simply, we know the price is going into the 60s, minimum. But now with Sprott controlling the primary physical uranium fund in the space, we really have a whole new era of financial player influence on a very tight and pretty illiquid commodity market. So, where can the price go? I mean, your guess is as good as mine. We know where it needs to go. Where will it go beyond that? Who really knows? If we ended up with an overshoot going into the $100 plus range, we're going to see really, really stupid valuations on the miners and kind of a euphoric phase in the bull market. So that's a very real possibility with the influence of financial players here.
Did you say 50 is the cost for these things to run like a break even? So uranium, if it's not did I misunderstand that at 50 it has to everything's based on $50 uranium, or?
No, well, so it's more like the average cost of production. But
Okay.
the cost of production right now, you could argue the lowest cost producer would be BHP with Olympic Dam in Australia, because uranium is a byproduct of their gold and copper production, and they just sell primarily right into the spot market or totally spot referenced term contracts. Besides that, you have the Uzbeks and the Kazakhs are producing, I would say that they're all in sustaining cost, or let's call it the fully allocated cost. If we're actually talking about the cost of capital and the dividend that they pay, they're in the low 30s per pound, and that puts them. They are the lowest cost producer. Their cash cost is in the teens per pound, but they're fully allocated in the 30s. And then we have what we're really talking about when we say $60 plus uranium is the production on the margin. So for some of these projects that are potentially going to come online with a supportive price, they need that level of price in order to justify raising capital, going into mine development, securing term contracts in that price range in order to make sure that they have a market to sell their uranium into. So a lot of these projects, they're just not going to come online just because the price is moving up and they think it's going to continue to move up. The price is going to have to go into the 50s and 60s, and they're going to have to sign some level of offtake agreements or long-term contracts to guarantee that they have a market to sell into. So once Cameco can sign a number of contracts in the 40s, they're likely to start to bring the McArthur River back on. That's a big mine, 18 million pounds a year. We're still in an imbalanced market at that point, but then you have a project like Paladin's Langer Heinrich. That's, they need 55, 60 a pound in order for them to bring that back online. Those are the two larger primary mines that are on care and maintenance that would be the first to come back before any new mines even think about coming. So just to get to that market that's structurally, quote unquote, in balance, we need to get to that level. But the way that this market works, balance from year to year is not really even relevant. I mean, having a supply deficit last year, this year, next year, that helps when it comes to clearing out mobile inventory that's available. But it doesn't really have a whole lot to do with the term contracting that has to come. So a lot of utilities globally are uncovered in the 2025 to 2030 range. And so they need to start signing long-term contracts within the next year or two, and that happens only with a rising price.
So high prices is the cure for high prices. I guess that logic still applies, right?
Yeah, for sure. Yeah.
So it's good. So the chart, yeah.
I was just going to say the chart there. I've just been doodling away whilst you're talking. I've sort of got up the chart for SPX and a couple of others that I was messing around with. But this one here for spot uranium, it targets around about the area that you were talking about there, $60 plus. I suppose within the next 24 months, something like that. I mean, in theory, of course, it could just go straight up, but something like that looks a little bit more sensible. So I don't know how that kind of timing and that kind of price action fits with what you're thinking, but that would fit pretty well with my forecast.
Yeah, that I think is pretty in line with a number of forecasts. I think we're really talking a 2022 to 2024 story with some more explosive moves on the commodity. Sprott is just now getting that new vehicle up and running. They should have an ATM within 30 days. They're going to be seeking a New York Stock Exchange listing, but even without that, they've got basically, I mean, the ATM, they can just continue to refresh. So assuming that funds flow into this new vehicle, it's going to be a consistent bid in the market. And that's not even to mention other hedge funds buying physical, or even, the utilities buying physical. So yeah, it's looking pretty promising. I wouldn't be surprised if it aligns with what you just projected on this chart.
Kevin, if this better hold, or else your reputation goes down the drain.
There's a bit of pressure.
It's easy for me. I didn't do any charts today.
Yeah.
Hey,
this
Justin,
market better hold.
I don't want to. We're like running. I don't want to take any more of your time there, but we're definitely going to need to for you to come back there, and as this evolves there, to see how the macro, the fundamental landscape changes, and how it fits with the chart, or how the chart fits with what you see on. Because all these calculations we're not aware of, like this mine needs $60 a spot for it to turn it online. Like, man, that stuff is like your subscribers. That's what they want, right? They crave that type of information. But
yeah, I mean, for us, the knowing the fundamental story is really paramount to being able to stick in with this investment, just because it's so volatile. I mean, if you just came in as a latecomer in April or May and kind of went all in sort of near the highs of this latest little cycle here without really having the conviction of the long term, or the mid to long term, let's say, 2 to 4 or 5 years, it's really difficult to not get shaken out. So we spend a lot of time on the macro and the fundamentals to give us conviction to ride out these volatile moves, and to know, when things sell off, when everything's rosy on the fundamental side of things, but you see a 35% sell off from the recent highs, then you have any dry powder. It's like, well, I'm going back in with some more here.
yeah, that's the hardest part. The having conviction in the trade, especially when it's like nothing's broken technically, or let's say fundamentally for the ones who follow that. But in the heat of the action, it's easy to throw everything out the window, right? The house is burning, push the wife down, and you're running out first. What? Did I say that?
You can edit it out. Yeah.
All right. All right. I don't know. Thanks, Justin. Kevin, if you want to see your au revoirs to Justin.
Yeah, brilliant, Justin. I've really enjoyed listening to what you've been saying there, and I hope the chart drawing and the doodling helped a little bit with the conversation. But no, fascinating stuff as always.
Yeah, thanks for having me. I have great respect for you guys and your technical skills. So it's very reassuring to see kind of some confirmation come from you guys on the technical setup here. So I'm glad we have the marrying of the fundamentals and the technicals. Yeah, I appreciate you having me on.
All right,
I'd be happy to come back.
Ciao. I'm going to stop the recording in 5, 4, 3.